Good morning, good morning. Let me know if it's working today, team. Oh, there we go. We've got Michelle. Hey, Michelle, thank you for my little present. That's wonderful. Thank you very much. Appreciated. Good morning to you guys. Good morning. Nicole, Alison, Michelle. Had a little bit of a technical issue yesterday. My internet disappeared. And for the life of me, I couldn't work it out. And then I tried to do the 5G, 4G hotspotting here, and that didn't work either. So had a bit of a technical glitch issue yesterday. So take two on this morning's or yesterday morning's Wealth Coffee Chat. Welcome to Wealth Coffee Chat, gang. Bunch of people on right now, so good morning. There's Graham and Bob, Belinda. Great to see a few of you jumping on. Pratesh is there also. Fantastic. Anyway, I'll do the quick intros, the kickoffs, whatever that might be. A few of you guys already know me. If you don't, if you're new, give us a shout out in the chat. Say hello. Jason Witten is my name. And each morning, around about 8:05, we get together. And thanks, Pratesh. My daughter bought me this. There you go. My daughter bought me that cup. For those who are new, say good day in the chat. And we've been getting together with those in mentoring for quite a while now. Each morning, each Monday to Friday, unless I've got some technical issues, we get a chance to catch up and have a bit of a wealth coffee chat about property investing, about going the distance. We've got a couple of sayings around here. This thing's a marathon, not a sprint. Buy well, never sell. It's going to take time to create the portfolio that you desire to create the wealth and the returns and the income that you want. So, as a property investor, it's great to run with people who are going in the same direction, to give you some encouragement, to keep you supported, to keep you in the game. So, welcome to Wealth Coffee Chats. If you haven't already, make sure you subscribe by notifications in Facebook or YouTube, or even the podcast. You can grab the podcast on Spotify and iTunes, etc. So good to see all you guys there. If you're new, like I said, give us a little shout out in the chat and tell us where you're from. And away you go. So dog laws, hey, updated in the rental world. Yes, it's an interesting little thing. But at the end of the day, I think if you get it right, Alison, there can be some upside to that, which means you can put your rent up a little bit if you need to cover those sorts of things. So, yeah, it's always an interesting balancing act, this world of being a landlord and trying to attract the right tenants. But today I wanted to talk about what that might sort of dovetails in there, the idea of returns. Calculating returns, understanding returns on an investment. Often I see a lot of people confused about what a return is. And, in the world of money and finance and financial planning, there's a number of ways that professionals use to communicate returns, and it's misleading. It might be misrepresented in the way that we need to understand things. So I wanted to take you guys through a conversation today about the idea of returns, and also as all of us are on the call we're property-centric return people. We want to understand how to appreciate the property calculation, those returns. So good morning, Margaret. Good to see you on today also. And let's have a bit of a look at what returns mean when it comes to us as property investors. When we are looking at returns, many people think that returns are only to do with the rental income. And that's only part of what happens, what we get as property investors as a a reward for owning an asset. Now, you guys have seen me do this before. I think, the other day at mentoring, you guys might have seen this one, residential real estate. Residential real estate. We've got commercial real estate. You've got the share market, call it stocks, shares, and you've got, joint ventures and other sort of deals that you can do. And we talked about the regularity of these returns, so the income you get from these investments, right? So chuck it in the chat if you remember the conversation from mentoring the other night. But residential real estate, residential real estate pays you, weekly. Okay, it's the most reliable income on the planet. Commercial real estate usually pays you monthly. Okay, I'm not a big fan of most passive income portfolio builders having commercial real estate. I think there's too much risk for most beginner medium-sized investors. If your portfolio is below 3 million, you're going to 3 million or 4 million, there's no need for you to have commercial real estate. Stocks and shares, you're going to get paid, maybe quarterly at best for stocks and shares. And joint venture deals or bigger deals, you might get paid on the yearly, okay? Now, as you go around this way, the certainty of getting paid 95%, 80%, 70%, 50%, that's the certainty of receiving that income, okay? So I've done a few other videos on that one before, but I just wanted to maybe just show that to give our conversation about returns a little bit more meat on the bone today, so we can have a think about what this looks like. And a gross return. You hear people talk about a gross return, and let's talk about the rent. So the rent that comes in, and you might hear the regular gross rental return of a residential property being 5% or 4%, okay? Now, how does that get calculated? It's pretty straightforward for anyone sitting there going, oh, well, how does that work? If you have a property that you pay $500K for, and it rents for, $500 a week, okay, the calculation or the process you do is you go, all right, well, $500 times by 52, or the weeks of the year that you want. So you go times by 52 equals $26,000 a year, okay? 26,000. So you go 26,000 divided by 500K, and that it gives you a percentage, or the other way around, sorry. 500K divided by 26,000 equals a percentage, okay? So you get a return based on the ratio of rent, income, compared to the price of the property that you pay. Okay, that's basic, simple math. You guys can get those numbers off of the spreadsheet that we've given you before, okay? So just laying a little bit of the foundation here for our chat today. So 5%, and then we end up with a net return, So stick with me this morning on this stuff, because it's a little bit gritty, but I want to explain something so we're not misled or misunderstand the value of what we get when we invest. We might be getting a 5% rental return, a 5%, maybe a dividend of 5%. Morning, Stephen. And then we might end up with 3.5% over here as a net return after expenses, okay? And, those expenses, are the rates and the insurance, and the agent's fees and all sorts of stuff, okay? And now we've got a net return. Now, we're not talking about cash flow. We're not talking about money in your pocket just yet. We're talking about a percentage based assessment of something that you own, right? Now, a dividend is calculated in very similar ways, but the dividend often has less expenses on the way through, and the gross return and the net return usually has some sort of what's called a franking credit involved in here somehow, okay? Now, this is where things get a bit complicated because it's very difficult to directly say, oh, property is better or worse than shares, or shares is better than worse than property, because they're not the same. You guys would know this. This is what can mislead to a bit of misunderstanding when it comes to analysing our returns on what we own. So if you own a property and you go, right, I get a 5% rental yield, I take out my expenses and I end up with a 3.5% net. In here, this is where you calculate your cash flow, but you minus your interest after your expenses. So you might be paying, 3% mortgage, and then you might end up with whatever the cash flow is after that calculation, okay? Now that's where leverage comes into play. How much deposit did you put in there? Did you borrow at 100%? Did you borrow at 90% or 80% or 70%? Those things are different. So a cash flow return is different to the percentage return, the gross and net return. Now, hopefully you guys are following along with this because it is complicated, all right? And that's why we give you, our cash flow calculator spreadsheet along the way. Now, someone can own a property and it can be negative cash flow and they're still very happy with that property because of the returns that they're receiving and also these next bits. Now, for most of us, we don't want negative cash flow property because it takes money out of our pocket and we can't own more, okay? But then as we analyze what it looks like, we need to understand what is the return that we need or we're aiming for as investors, okay? So let's keep going along with the property one. We got a 5% rental yield. We minused our expenses. We end up with a 3.5% net. We then go ahead and minus our interest against what our leftover cash flow is, and we end up with a cash flow calculation. Then what happens in analysing our returns, these are the hard numbers. We know we can get a really good calculation, and these ones become soft and squishy numbers, not real numbers, on paper numbers when it comes to owning certainly real estate, okay? So growth, let's say there was 5% growth for that year, okay? As we go along, and then we go, right, a total. How do you total the growth of real estate? Your total return. And it's quite hard to sort of analyze. What do you do? The gross return? Do you do the net return? Do you do the return after your cash flow? Good questions, okay, as we look at it. So what I like to do is all of these things in here, which is your expenses and your net returns and those things, they are adjustable depending on who you are, depending on your circumstance, depending on what type of borrowing and lending you get. These ones are the personalized issues. So for me, what I like to do is I like to say that stuff is fluid and flexible. I want to analyze my returns based on, all right, the gross return is 5%. I got a 5% return across the marketplace, and my total return potentially would be 10% for the year, maybe. Okay. Now it's book entries, exactly, Michelle. So we're looking at that, right? So you're saying, oh, a 10% return, is that good? Yes, it's great. A 10% return compounding over 20 years is significant. It's fantastic, okay? And you can analyze the share market in a similar way, okay? You got a dividend, hopefully, you know, maybe you got a market growth, and then, you know, you got a 10% return, okay? So when we get over to the end of this thing, one of the things about real estate that's excellent is we have a little kicker at the end when we can have some extra tax deductions, some add back, okay? So along the way, you know, this is the return, you get 10%, okay? That's it. The share market, you've got no depreciation, you've got no tax offsets, you know, away you go. With real estate, though, we have often, it works out for most people, PAYG, we kind of get this 1% add back in our returns. So, you know, 10%, we add another percent back into our real cash flow, like it back into our pocket, because we get to offset some tax, and we get a little bit of an uplift at the end. Now, there might have been a hard one to sort of work with today, but I wanted to just lay out this kind of process for all of us as property investors when we're analysing deals and we're analysing returns and so on. We need to sort of have a look at the high level conversation, the gross rent, some growth, our total return, add some tax back because you are being efficient in that space, and that's great, okay? Now, the challenge sometimes will be things like maybe the year you get, you know, a minus 5%, okay? Growth. Maybe that's what happens. And you've got to make sure that you don't react in that way. Is that normal? Is that abnormal? That's totally normal when it comes to this sort of stuff, okay? So hopefully that makes sense. Maybe it doesn't make sense. Let me know in the chat if it made sense today, this conversation, or opened up more questions in your mind when we go, what are our returns? What makes sense to have a look at as we calculate real estate ownership and other pieces of investment, and what can we rely on into the future? Thanks, Pritesh. Yeah, it does take some time. It does, and you're right, because it takes some time to get our heads around these things, because clear as mud, because it's not something we're taught at school. It's not something that's kind of we're taught in the normal go of things, and there can be some misrepresentation. And we say, right, you know, you might go see a financial planner. This is a classic misrepresentation of reality versus theory, right? You go, oh, you know, if you buy shares, your total return will be, you know, 12% or something like that. Now, you know, the return is based on buying and selling shares. You know, there's a fund that buys and sells shares, so it creates a return. With real estate, we're not buying and selling with our portfolio, okay? There's no locking in a profit when the property price goes up. You don't lock a profit in so you can put it on the balance sheet in comparison to what, let's say, a fund manager does with shares. And so trying to compare the two is flawed, because our property portfolio is owning forever, and a share portfolio is literally buying and selling shares almost every day. So the behavior of the asset is completely different, and so too the returns can't be compared apples for apples, because it's not the same behavior, it's not the same ownership. One's trading and one is owning. Yep, not trading. Yep, exactly, Michelle. Well, there you go. Hopefully, anyway, if it didn't make a lot of sense and it was a bit kind of, what the, Jason, then that's great, because then we need to sort of, as we go and own things into the future, we need to sort of rationalize and understand the returns for us as investors what's working for us and what's not working for us, etc. Anyway, there you go. I was going to try and make it as clear. All clear, says Graham. Fantastic. I was trying to make that clear, but hopefully it stimulated something for all of us to chat about. Anyway, that's it. Wealth Coffee Chat done. The technology's back on track, and we'll be back at it tomorrow. A shout out for everybody. Tomorrow afternoon, Andy Fenton and I are going to circle round at Wealth, Wine and Wisdom for our catch up after mentoring. Andy come and presented at mentoring, so make sure you get on that one as well. Hey Rosita, good to see you. And yeah, there'll be a lot of questions answered at Wealth, Wine and Wisdom tomorrow. Anyway, Wealth Coffee Chat done and dusted. You guys take care. Be safe wherever you are. And until tomorrow, around about the same time, 8:05 to 8:10. That's it done for another Wealth Coffee Chat. See you, team.